Welcome back, everyone. Okay, so in our last explainer, we mapped out the standards landscape and locked in our core vocabulary. Making sure we're all on the exact same page when we talk about a net receivable, an allowance, a write-off, an amortized cost. But today, we're making a pretty pivotal shift. We are moving right out of terminology and into practical application. The fundamental question we are tackling today is exactly when to record a receivable on the books. It sounds super simple, right? But honestly, getting this timing right is the absolute bedrock of accurate financial reporting. Here's our roadmap for today. First, the recognition principle. Second, we'll run through some trade receivables scenarios. Third, the contract asset distinction. Fourth, notes and interest receivables. And finally, the critical cutoff rule. As we flow through these, notice how we anchor every single scenario to one universal golden rule. All right, part one, the recognition principle. Think of this as the golden thread that ties everything we're going to talk about today together. Let's define it. Okay, let's really dive into this. A receivable is recognized when, and literally only when, the company has an unconditional right to receive payment. So what does that actually mean for us? It means a past event has already occurred, and payment depends strictly on the passage of time, not on satisfying any extra obligations, not on doing just a little more work for the client. Absolutely no further effort is required on your end. The very second you cross that finish line and your right to that cash depends only on the clock ticking, boom, you have your trigger. That unconditional right is exactly when a receivable is born. Moving right along to part two, trade receivable scenarios. Now that we have our golden rule, the unconditional right, it's time to see how it holds up in the real world. For trade receivables, this ties directly back to revenue recognition under ASC 606. Generally, this happens when control of the goods or services transfers to the customer, meaning we've done everything required under the contract. Let's test this out with a few examples.
Let's play a quick game of yes or no. Goods shipped and ownership transferred? Yes, definitely record the receivable. Your performance obligation is totally satisfied. Service fully performed and accepted? Yep, record it. The right to payment is unconditional. But what if, say, a customer order is received, but goods aren't shipped yet? No way. No performance has actually occurred yet. You've got to wait for delivery. And what if you proactively sent out an invoice, but the goods haven't even left the warehouse? Absolutely not. Sending a piece of paper or, an email invoice does not magically create a receivable. Control of those goods must transfer first. Now, there is one really special scenario here. What if services are partially performed, but you still have to complete them before you can invoice? This one is tricky enough that it deserves its own spotlight.
Which brings us to part three, the contract asset distinction. This right here is a crucial gray area that trips people up all the time, and getting it right is vital for accurate balance sheet classification. Think about the conditional nuance here. A contract asset happens when a company has partially performed its duties, sure, but it must do more work before earning an unconditional right to payment. Your right to that money is entirely conditional on you finishing the job, so it is simply not a receivable yet. In sharp contrast, a true receivable only arises once the right flips from conditional to unconditional. Why does this matter so much? Well, because misclassifying a contract asset as a receivable completely throws off your balance sheet and ruins your period-end cutoff testing. Always ask yourself, do we have to do anything else to earn this cash? If the answer is yes, you are looking at a contract asset, my friend. Section 4, Notes and Interest Receivables. We've spent a lot of time just now on trade receivables, but let's pivot slightly and see how this exact same golden thread applies to lending and time-based accruals. Let's look at notes receivable first. The trigger here is super specific. A note receivable is recognized when two conditions are both perfectly met. The lender has actually transferred cash or goods to the borrower, and a legally enforceable written note agreement exists. So the absolutely crucial point is the recognition date. It is the exact date the note is signed and the funds are dispersed out the door. It is not the date the first repayment is expected to begin. Once the money leaves your hands and the ink is dry on that contract, your unconditional right is officially established. Now let's move to interest and see how this builds. Interest receivable is recognized as interest naturally accrues on outstanding balances, and we use the effective interest method for this. The math is pretty straightforward. It's just the principal multiplied by the effective interest rate multiplied by the days elapsed divided by 365. But here's the most important takeaway you can give your finance teams. Interest receivable is a mandatory period-end accrual. At every single period end, you calculate the interest earned but not yet collected in cash, and you record it. Period. It should never ever be skipped just because the actual cash payment hasn't arrived in the bank yet. The mere passage of time is the event that triggers your unconditional right.
And finally, Section 5, the critical cutoff rule. We're at the climax of our explainer today, and we need to talk about the trap. This is the highest risk area where that unconditional right principle gets violated all the time. The absolute most frequent recognition error in accounting is recording the receivable when the invoice is raised rather than when control actually transfers. Yes, often the invoice date and the control transfer date are exactly the same day, but definitely not always. Think about period end. It's extremely common for an invoice for December shipments to be raised in early January, or you might literally have goods sitting on a truck in transit right over the balance sheet date. If you just blindly use the invoice date as your trigger, you will fail your cutoff testing. The rule is strictly consistent across all receivable types. The receivable only exists when the right to payment is unconditional.
And because of this exact trap, your documentation matters immensely. You got to support the unconditional right with the right evidence. What proves the delivery event actually happened? Well, actual shipping records, service acceptance sign-offs from your client, loan disbursement confirmations. I want you to remember this mantra. The invoice is simply evidence of billing. It is not evidence of delivery. To record a receivable, you absolutely need evidence of delivery. So I want to leave you with this provocative thought to chew on as we wrap up today's explainer. Go take a look at your own books. As we approach period end, are your receivables backed merely by a piece of paper and invoice, or are they actually backed by a true unconditional right? Getting this right is the total foundation of ASC 310. Keep that golden rule front and center in your mind, because in our next lesson, we are going to dive into measurement, taking that unconditionally recognized receivable and tracking exactly how its carrying amount evolves over time using amortized cost. I can't wait to see you there.